Akber, in the break, you warned me that the Gulf wasn't going to be the biggest winner from supply crunch, but certainly sets the stage for a boon. How will it manifest, and how can I position for it, directly or indirectly?
Morning, Manus. Thanks for having me back. The expectation after COVID hit was that there would be severe problems with demand, pretty extreme and extraordinary stimulus from governments has helped demand come back. But really the lasting problem at the moment has been distortions to supply chains. They've been creaking, and at the same time, we've had the transition towards the global economy really pick up speed because of the focus on carbon emission reductions. This has led to a number of issues. You've been talking about petrol shortages. This has led to changes in usage of fossil fuels, a reduction in usage of fossil fuels. All of these things have led to a surge of a wide range of commodity prices, and a lot of the best global debt and equity plays for those are actually in the Gulf. So we've kind of come full circle, and bingo, here we are in the Gulf, able to capitalize.
I know that you certainly got my eyes going. Vinyl acetate, I thought that was for records, but you've expanded my horizons. Can we just qualify for our viewers? Is there a great deal of depth and breadth in ammonia, aluminium, vinyl acetate, and LNG? What is my risk trading directly into those commodities? Is there enough depth there, first of all? Just qualify my risk.
It's a good question. We would actually we see far greater leverage in buying the companies that manufacture them rather than buying the underlying.
Okay.
Because of operational and financial leverage in those companies, you will get probably very strong returns, and you will avoid some of the liquidity that you may encounter otherwise. The likes of Qatar Aluminium Company, Sabic Agri, Safco, as people know it, Sipchem, Ma'aden, Industries Qatar. We've been flagging many of these for a while. We expect them to have record profits and in some cases record dividends next year. But this is how we would play a lot of these trends.
So just on that, I mean, we're showing our viewers that board. Of course, we're in the classic disadvantage. I've got the board in front of me. We've got Qatar Industries, Sabic, etc. The one thing that went through my mind, and Yousef Al-Bayan owes us an interview. His flak will not respond. Do you think that these companies grab market share in a crisis like this?
Well, by virtue of having some of the lowest cost producers in the world in the Gulf, that's one of the reasons why when you have crises where you have a surge in commodity prices, people think of the Gulf and they think of oil and they think perhaps of gas, but really we produce a lot of the derivatives of these, or we produce commodities in the region which utilize very cheap energy, and as a result we have some of the lowest cost producers. So that's why some of these companies in the region are some of the best ways to play this globally.
Akber, that brings me to, I've got one other CEO who's sending me WhatsApp talking about his own call on oil this morning. The last time he was with me, it was rather prescient. Oil's over $75 this morning. We're breaking higher. People at Goldman Sachs are talking about a tight market, and they've upped their Brent price by $10 to $90. They also lifted their 2023 outlook to $85. Does this squeeze endure? Do you agree there's another $10 left in the upside? And what's the consequence of that $80, $90 oil if it endures?
So I think 2 or 3 months ago, Manus, you and I were having a chat about this very thing. I think oil at that time was in the mid-70s, and it came down again, and it's come back up. And really, I think from our perspective over the medium term, the transition to the green economy is going to be very beneficial for oil and gas exporters. It sounds counterintuitive, but because there is so much pressure to reduce the medium-term supply growth of fossil fuels, the counterbalance, if you like, which is the increase in demand from renewable energy, is not coming up anywhere quickly enough, and is not as regular. So as a result, we've had coal mines come back being activated. We've had an increased demand for increased oil production, et cetera, et cetera. So we think that as this transition to the green economy continues over the next 5 or 7 years, it'll underpin oil prices. So whether it's 70, 80, 90, 100, there is room for surges higher in some of these prices. Sustainable numbers to avoid demand destruction probably don't want numbers around $100 oil, but it's possible for us to see this from time to time.
Let's circle back to one of the companies which is in the process of delisting here, which is DP World. Now, it's interesting that you talk about the boom in e-commerce, the shipping, the freight mania, and the freight rates. We obviously can't play DP World via the equity story anymore, but you do like, and we love a sukuk on this show, you do like the bond exposure. I'm showing our viewers a 6-year perpetual sukuk, and this is where I think that you have a pretty strong call. Where can DP World 6% perp get to? Where can price rally to and yield fall to? And do you scale into it?
So, yeah, thanks for highlighting this. The DP World is one of the strongest credits that we actually have in Dubai. It's currently rated BBB-. It has many sukuk on the curve. The PERP, which is a $1.5 billion issue, is our preferred play. It has a first call in October 2025, and if it doesn't get called, the 6% coupon gets stepped up by 500 basis points, so it'll become 11%. So the expectation of the call is very, very strong. The key thing here is that this, with a high coupon, a yield which is north of 3% at the moment, there's a considerable pickup relative to the rest of the curve. But the key point here is that given the number of acquisitions over the last 18 months, leverage is about 6 times net debt to EBITDA. The company has an internal target of bringing this down to closer to 4 times. And if they do that over the next couple of years, you could see a definitely 1 and probably a 2-notch rating upgrade. As a result, you could see the spreads come down sharply. The price would obviously react accordingly, but there is still significant further upside in this. Even if it doesn't go anywhere, you're getting a 6% coupon just to play the waiting game.